Hello everyone, my name is Kamal Manocha. I represent PMS AIF World in the rhythm of webinar doing every Friday. Today, we have Mr. Samit Vartak, who is CIO and founder with SageOne Investment Managers. He needs no introduction, and this particular webinar is not to discuss, markets. Is not to discuss what is a view on markets. We have been doing, off and on in some of the earlier webinars, but here we want to understand the overall process of identifying multibaggers, because there is this saying, then one should not run after success, one should run after excellence. And that's what I mean by process. And if one runs after excellence, obviously success follows. SageOne has proved that over its decade of track record, whereby it has actually multiplied wealth by more than 10, 11 times for its clients. And it's kind of on long-term returns, even medium-term returns, SageOne's performance is excellent. And that is exactly, we want to understand why the process behind that is important. However, obviously over last 1.5 years, something abnormal has happened, because we were not used to so high interest rates, especially the western part of the world had seen interest rate rising so sharply maybe 3 decades ago, and the same has happened in 2022, whereby interest rates went up from almost 0% to as high as 5% on Federal Reserve rates, which has led to many growth stocks, many, I would say, high PE stocks falling down. But because some of these companies in the mid cap space, in the small cap space, which are actually delivering good returns, which are delivering good results, are kind of becoming all the more attractive in terms of valuations. And that is what we want to understand from Samit today in the overall context of today's webinar, because we know that over last 1 year, SageOne investors are disappointed, because there has been very high expectation over a decade. Many investors have actually handed over their hard-earned money to you, Samit, and to SageOne Investment Managers with a great hope, with a great expectation. Everyone understands equities and asset class is non-linear, and all of us are together in it. And all our investors are kind of long-term investors. But over last 1 year, there has been a deep underperformance. So to begin with, we want to understand from you, what are your thoughts around underperformance which has happened over last 1 year, and what is it that SageOne and your team kind of doing behind the scene in terms of reviving it? What are your thoughts in this regards? Welcome formally, to this webinar, Samit, and over to you.
No, first of all, thank you for inviting me, and great to be here. And I will, try to be, as frank as possible, and give my views. So good to be connected to, all the investors and listeners. Yes, see, I recently published a memo, and in which I've tried to showcase how cyclical returns are, because people do look at point-to-point returns, and but that's not always the case. As you said, returns are never linear, so in the long run, yes, returns will converge to your long-term sort of average, but there will be periods, and I've shown even for SageOne, we have been doing this for the last 11 plus years. So I've shown how the rolling 3-year average has been. So the rolling 3-year average has been on the higher side, as high as 65%, sometimes even -4%. Right? So that's how wide the range is. The median is about 24%. So it's not necessary that every year we would be able to beat the markets. Every year we would be able to deliver, returns. We were doing pretty fine until say May 2022, where if you look at our returns, we were beating in terms of 1 year, 5 year, whichever period you look at. We had underperforming, next 7 months, especially until December 2022. And then when you look at that point, from that point of view, there is underperformance. And then last 4 months, this calendar year, we have outperformed again. So this is going to be cyclical. Even if you follow the same exact process that you have followed over the last 11 years, there is a big part of how markets work. Whether your strategy is something that the market is rewarding. Sometimes markets reward different kinds of stocks. It rewards sometimes PSU stocks, sometimes very commoditized stocks, sometimes high growth, sometimes consistent compounders. And depending on your strategy, if your strategy is what the market is rewarding, you will do way better than what others are doing, right? So but in the long run, I do believe that earnings growth is what will deliver you the long term returns. In the short run, valuation do deliver a lot of returns, but in the long run, the returns will converge towards the earnings growth. And what I mean by long term, obviously, long term is more at least one cycle, but sometimes even one cycle is not enough. I would say a cycle in the small cap space lasts for about 3.5 years, right? But a fund manager can completely get sort of unlucky, or he can get things wrong. I mean, it's I'm not God, right? That each time, because after all, in equities is about finding businesses which will deliver in the future. I can't see the future. There are, we do follow the processes to sort of forecast, how the businesses will do in the future. Hopefully, even this cycle, we will get many businesses right. We will find many, multi-baggers even during this cycle. And I presented in the memo how small cap cycles work, right? So small caps peak every 3 years. So, and not necessary, I mean, this is not something which is a mathematics that it has to, really peak every exactly 3 years. Sometimes it can be 2.5 years, it can be 4.5 years, so there can be a pretty wide range when it would peak. So 2008 it peaked, then 2011, 2014, 15, then 2017, 18. Last time it peaked, of course, you know all this in hindsight, that it peaked in 2021, late 2021. So whoever sort of invested, during that period has gone through that correction, and that correction typically lasts for 12 months, 15 months around. So we have sort of completed that kind of a correction period. Hopefully, the trough is in the past, and if you assume the 3 years kind of a cycle, the next peak would be somewhere towards the end of 2024 or 25. So I mean, when we launched the AIF, it was from that perspective, is that let's at least raise funds when the markets sort of have peaked, and we'll get most of the funds when it's correcting. But an initial phase of correction, sometimes if it lasts too long, it is frustrating. But investment is all about keeping that patience. And as a fund manager, our job is to, if we get some things wrong, of course we got to correct it. If we get some companies wrong, you exit it. Sometimes if you get them right and the market still punishes those companies, you add on to those kind of stocks. So those kind of sort of tweaking we have done in the last 7-8 months, and most of the investors would have seen that. But I am fairly positive over the next 2 years, where I think the next peak would come, and whatever generally losses which are made during the correction phase in the small cap is more than made up during this sort of the upside. Again, as you said, there are headwinds like the interest rates, and there are going to be always headwinds. Question is, considering those headwinds, are your individual companies going to deliver on earnings growth? So those are the things that at a micro level we do evaluate, and we have evaluated those and made sure that if we thought that the earnings growth expectation that we generally have from the companies, if it's not going to be met, then we have gotten out of those companies. We have probably exited out of 5 or 6 companies, even more in the past 6-7 months, and we have added new companies where we are more confident that the companies will deliver on the earnings growth, as well as their valuations were pretty attractive. So those are the changes that we keep on making to make sure that if there are many mistakes, we get out and we correct the courses, and hopefully in a 3 to 4 year kind of a period, we would probably go back to our sort of average kind of returns.
Sure, Samit, you made a very pertinent point that yes, attractive valuations could make short-term returns, but longer-term wealth creation happens on the basis of growth in earnings. So from that point of view, let's base that as an argument. And if you were to kind of give some numbers on what is the expected earning growth from your both the portfolios, what in the current context, because we have seen some companies which
Yeah.
have been delivering great return, great results, and you mentioned that you have exited some of the stocks. We don't know, and we do not want you to reveal those stocks.
Right.
It's up to you. If you think you want to share a couple of examples, you can take.
Sure.
But the thing is, I want you to give flavor of what is the expected earnings growth of both the portfolios.
Right. See, now let me give you a context of what is the overall earnings growth of the Indian markets, right? And with that context, I'll try to provide what are we targeting, right? So if you look at last 20 years or 25, 30 years, right, the nominal GDP growth for India has been about 12 to 13%. And if you look at the historical returns, right, not point to point, that's what also I have presented in my memo, is if you look at the rolling average median of the last 20 years or last 30 years, it's including the dividends, it's been about 12 to 13%. So the returns have almost mirrored what the nominal GDP growth has been for India. And nominal GDP generally has been sort of a reference point for earnings growth, in the long run. So earnings growth in India in the long run is going to mirror the nominal GDP. Going forward, the nominal GDP expectation for most people is going to be in that 10 to 13% range, depending on the inflation, right? So if you assume that the real GDP is say around 6 to 7%, what is current ongoing, add to that say 5%, 4 to 5% inflation in the long run, right? So that gives you around that 10 to 13% kind of a. So long run earnings growth for the Indian markets is going to be in that range. Some companies, some industries will grow faster than that, but this is going to be the reference point. What we are targeting and what we have been targeting is companies which will double its earnings in 3 to 4 years, because we work in those kind of a cycle, and 3 to 4 years, meaning that if the company doubles its earnings in 4 years, the growth is 18%. If the company doubles in 3 years, the growth is 26%. So we target companies which will grow in that 18 to 25% kind of a range, with an average of say, around 22% kind of a growth. If we do not find such companies, we are fine sitting on cash. But any company that we invest in, our expectation is that they will at least follow this kind of a growth rate, right? So of course we will get some wrong, like for example, you're asking which are the companies that we exited. I mean, some of those companies, couple of those companies were chemical companies, so there are chemical companies, for example, which have been multi-bagger for us. For example, Deepak Nitrite, it's we entered at say between 200 and 250, it went to as high as 3,000, and then from there it corrected to 2,000. But not necessarily that, we would be able to exit at that point, because if we keep on exiting so quickly, then you will never find a multi-bagger which is going to be 10x, right? So you need to have some patience, but sometimes, there will be a point when maybe there is a point to exit that company, because structurally things have changed. So what happened in the chemical space is that if you see the post-COVID times, there were so many restrictions in terms of logistics. There was short supply of so many chemicals which were going into pharma, which were going to different kinds of industries, that many companies, because of those issues, started stocking up much more inventory than what was needed, right? So suddenly the demand for many such companies, it's not just chemicals, but if you look at textiles, you look at pharma, there's so many industries where there was sudden rise in demand, right? And because of which suddenly the profitability of a lot of these companies went up. So profits in chemical space, in textile space, in a lot of even other industries went up. And then what happened is that there are many companies which ended up expanding capacities. It's not just India, but across the globe, right? And when things normalized last year, you realize that anyways companies had a lot of inventory. They started destocking, and because of destocking, there was no new buying that they had to do. At the same time, things normalized, logistics, came back to normal. The supply also increased across, and plus there was new capacity which was coming up. So China also opened up completely, and it has put a lot of pressure on the margins of many companies, right? So because of this, it's not just temporary that the margins are contracting. It's possible that this overcapacity may impact the margins for much longer term. So this is something that you realize, and as soon as you realize that it's a more structural story, you get out of such companies. So we have gotten out of companies like Deepak Nitrite. We also got out of companies like Balaji Mines, because we feel that the longer term impact we can't predict, and it will have impact on the growth of the growth in the earnings. And so against that, there were companies, for example, couple of companies which did correct during that time. So for example, Canfin kind of companies, right? So because there were some temporary issues, but then we of course deeply evaluated such companies. From say 650, it went down to like 450 in a matter of just a month, right? But then when we evaluated, and then we felt that structurally nothing has changed. The business is as strong as it was. There were some temporary, short-term issues in terms of question mark on some fraud that happened at one branch, or the CEO was leaving. But we felt that it's worth holding because the valuations were cheap. So we actually even added, during such times. That stock is now back to all-time high, right? Another company, for example, Century Textile, it also corrected sharply from 1,000 to went down to 600. But then when you look at fundamentally how the companies, are doing, they're on track or even better than sort of the earnings growth that we were targeting. Right? So even there, we have held on and sometimes even added. And that company also, then in the long run, it will reflect, what has been the underlying growth. The valuations are extremely attractive, and Canfin is trading at, say, 13, 14 times trailing P multiple with an ROE of 20%, which is sort of the best in the industry across NBFCs and banking segment. Century Textile, if you look at, last, its valuation is barely 8,500, out of which they have three businesses. They have the textile business, they have the paper business, and they have the real estate business. Now, if you look at the valuation, the textile and paper business altogether keeps on generating, 500 to 700 crores of cash flow every year. Even if you, give it a 7-8 times of cash flow multiple, it still is, at least 4,000 crores market cap. So real estate is only 4,000 crores, 4,500 crores market cap, right? And if you look at their just one project, which is the Worli project, and their first phase is 80% sold out. Right? They have almost 5 million or 50 lakh square feet to be sold in that, which they're expecting to sell in the next 5-7 years. Right? The top line from that itself is expected to be close to 25,000 crores. So 25,000 crores top line, and the cost, because land is their own, the cost of if you assume that 75,000 today is the selling rate there at a carpet area, the cost is about 20,000 rupees square feet at a carpet level. That's the EBITDA margin is pretty high. So, you can assume even if 50% EBITDA margin, they will generate 12,000 crores of cash flow from just one project, and you are getting that company for a 4,000. Plus they have lands in Bangalore and, NCR region, Pune, even Dombivli, they have 100 acres plus land. So if you find such companies where you expect that, in the next 3-4 years, they will significantly deliver, compared to what their market cap is, we have added. And we keep on evaluating the portfolio at every point in time. It's not necessary that just because we thought, this is a great company, if after a quarter, if something changes, we are open to making those changes and replacing it with something, better. Or so those are the things that, we keep on, doing, and hopefully what we have delivered in the past, should happen, over a longer term period, which is not going to be 1 or 2 years. We will disappoint you, and I don't even know when we will disappoint you, but hopefully in a 4-year kind of a period, we will at least go back sort of to the average returns. Again, returns are also driven by how the markets are, right? If the markets are going to collapse in the next 3 years, you never know what will happen. But if they are at least behaving similar to what they behave in the past, we should, at least the companies that we have, I think they should deliver on the earnings, and valuation has contracted a lot in the last 1 year. I mean, the P multiple for most of our companies on an average, say, was at 30 times. Today it's at closer to 20 times. So those valuations in a good time period will also bounce back. In the meantime, the earnings would have gone up significantly. So hopefully in a cycle, we will deliver what we had started, or what we started with as an expectation in terms of returns.
Sure, Samit. So you mentioned that your view with regards to chemical sector has actually changed, and there have been certain exits from the portfolio. But what is the sector kind? Because specialty chemical sector had actually generated a lot of wealth over the last 7 years, and now when your team is trying to figure out future multi-baggers in your portfolio, any particular sector that you are bullish upon, maybe for next 3 years? Because I agree that you may not be able to give a view beyond 3 years, but still, whatever view you have, which is optimistic on any particular sector, I'm really curious to know that.
Right. So again, it's, we do not do macro investing. So it's not like we take a view. So even though I'm positive say on the chemical sector, but the structurally things have changed so much that it will impact the margins. So the sector may grow, but if the margins are going to be impacted for a longer period of time, as an investor, you will not make money, because you will never get the valuation, you will not get the, EPS growth in those companies, right? So I was extremely positive on that space a year back or 1.5 years back. But as situation changes, environment changes, you have to react to it. And today we have very little exposure to the chemical, space. The industries where I'm positive on, and that's mainly because of the bottoms up. What kind of companies are we finding value in? Because it's not just about the prospects, but also where the valuation is attractive. I feel real estate is one of the spaces. Any in building material that you're needing for infrastructure, I'm still positive on it. So whether it's the structural tubes kind of plays, or there are compressors or generators which are going to be used for capex, whether it's capex in real estate, whether it's capex in infrastructure, railway capex, so any bearings which are going into railways, stainless steels which is used for manufacturing of railway wagons. So indirect plays, where India will need to build infrastructure, whether it's building railways, airports, warehouses, data centers, roads, niche players which are catering to these, building materials. But these are not commoditized building materials. They are niche, they are leaders, and it's very difficult to enter those kind of industries. I'm extremely positive. So real estate, such niche players, and then mostly, completely bottoms up, like, what say is like Canfin Homes, so those are the plays on which, we are betting.
Sure. Otherwise, if one was to kind of see the indices, which is like NSE 500 or Nifty 50, obviously your portfolios are more mid and small cap bias, we understand, and you follow index agnostic strategy. But generally weights in index are more towards financial services and IT. But your portfolio is absolutely altogether different. Is the view with regards to financial services beyond, say, Canfin Homes? going to change now when interest rates could fall, say, over next couple of years, and or you are going to continue with the same older philosophy?
Yeah. Yeah. No, I mean that's a good point. Because generally most fund managers do hug the the indices, and then they do over or under allocation. For us, it's all bottoms up based on the earnings growth that we are looking for, right? So we are looking for companies which will double its earnings in the next 3 to 4 years, as I said, which ranges earnings growth ranges from 18% to 26%. Now, tell me a bank or most of these financial large companies which will be able to grow at that. I mean, if the nominal GDP is going to grow at 10 to 13%, it's very difficult that credit growth or the financial services growth will be way beyond the nominal GDP growth rate. There are companies like, say, Chola or Bajaj Finance which probably will grow at that high rate, but then again you have to look at the valuation. So either the growth, wherever the growth is high, there is problem with the valuation, or if the valuations are cheap, there is problem with the growth. None of either of the two situations are not acceptable, to our strategy, right? So that's where if we find one of companies like these, like say Canfin Homes, where the valuation is extremely attractive, and with return on equity of 20%, though that company still grows at that 18-20% kind of a range, we will buy it. Similar is the case with IT companies. I mean, IT had a sharp jump in growth after COVID, but then in the long run, its growth will be going back to the usual growth of 5 to 10% in USD terms, right? And even if you add depreciation of say 4% in rupee terms, it will be still in that nominal GDP range of 10 to 13%. And so if they don't meet our earnings growth rate, we would rather be out of those sectors. If we find exceptional, one-off cases in between, we will stay with it. Like LTTS is something that we had held on, but then again the growth rate is slowing down, and there's so much of uncertainty in the US markets, and with the banking issues that we have seen in the US markets, it's possible that the capex that they do will slow down, and that will impact how the IT companies grow. So with that sort of worries about growth, especially in the export-oriented kind of sectors like IT, we had one company which again we exited, during those last 5-6 months, right? So yes, we will just focus on bottoms up. Wherever we find earnings growth of 18-20 to 18 to 25%, we will just invest in those kind of companies.
I remember, asking you this question in last annual summit, where as the AUM of your PMS is now rising, could be a limitation, beyond a point for you to find companies in the mid and small cap space. And many clients of ours or prospective clients who want to invest in SageOne still, ask this question, because investors feel that, when the AUM is large and the focus area is small caps and mid caps,
Right.
and after doing an investment of say 5% allocation to a stock, if it is realized that it needs to be exited at a point when something worse is happening, it could be impossible to exit, and hence invest and fund manager will have a bias to continue to hold that. And many larger, I would say, AMCs have kind of gone through that. But because SageOne is one unique such AMC which stops taking money, especially in SSP, we have seen that, and whenever such situation comes. But we have not seen that ever happening in, say, your core portfolio. So what are your views in this regard, and how would you address
Right.
such queries of a client?
Right. See, you are right. I think in the small cap, we have two portfolios, and then there is the AIF, which is a combination of the two, right? So in the small cap, we stopped taking money because it reached the sort of the peak that we had thought, is the manageable AUM, which was 1,000 crores. That's a 1,000 crores, and we stopped, taking money in that. What we do is that we look at 1% threshold. So, for example, in the small cap portfolio, the average market cap is 5,500, right? We can go max up to 20 stocks. I think we are closer to that now. in the small cap portfolio. So the total market cap of the portfolio is 5,500 multiplied by 20, which is 1,10,000 crores. 1% of that is the max we want to manage, right? Because below 1% we do get reasonable liquidity. Of course, not ideal liquidity, but that's a sort of a good balance between liquidity and sort of decent size. So 1,100 is like our total size that we want to manage, but we stopped earlier because there will be clients who will be topping up, and we do allow top ups in the PMS, right? So that's, this small cap 1,000, including the portion in the AIF, which is also small cap. So PMS is much smaller, but the portion in the AIF. So we stopped taking any money. The core portfolio average market cap today is about 20,000 crores. So there the market cap of the total portfolio, 20,000 multiplied by 20, so about 4 lakh crore. So we can manage up to 4,000 crores there. Today we are closer to maybe 2,500 crores. So there is some room available, and we feel the valuations are attractive. So we will stop either when we think that the valuations are not attractive or expensive, or we will stop if we have reached the capacity. So both of those situations don't hold true for core portfolio. One of the situation does hold true for the small cap, hence we have stopped taking money. AIF is a closed-ended one, so anyway we can't add. We closed that in December, so now we can't add any money. So small cap and AIF is completely closed. Core portfolio is something which we have kept it open because of there's no liquidity issue in that.
You did give a positive view on real estate sector. There are a lot of clients and investors who would have definite vested interest in real estate sector as well. And this is an interesting, aspect that you have kind of spoken about, because I have seen over my career, many fund managers actually hate real estate sector. They say that real estate, commodities, some of these sectors are like, we don't do. Obviously,
Right.
Times may change, times can change, and finding opportunities is all about, I would say, portfolio management. But in the current context, over last say 1.5 years, even we have seen real estate prices going up as a commodity prices. So, but at the same time, interest rates have also gone up. So while interest rates are almost at their peak, and real estate market is also kind of back to its all-time highs, from here onwards, why is it that, first of all, why is it that real estate prices have gone up over last say 1 year when interest rates were rising? Because this kind of puts doubt also in the minds of a lot of investors who feel that this is a cartel driven market where there are no logics. How can in the rising interest rate era prices of real estate continue to keep going up? And real estate market in terms of prices in certain metros, like you talk about Delhi, Pune, many other cities like Bangalore also, or Mumbai, prices kind of they shock many I would say investors. So because you have done some deep research and now you have a positive view on real estate, so it will be very interesting to understand your thoughts around this sector.
Sure. Yeah. So see, real estate also works in cycles, right? So, at least the cycle lasts for 5-6 years, right? And we had a long period from 2012 onwards to, post COVID, after COVID. So until 1.5 years back, that the prices hadn't moved much across most of the larger cities and across. And then in between we had, the RERA issue and, so I think there are few things that, make us positive on this segment. One is there were a lot of bad real estate projects. You have seen the impact on Edelweiss and many other, financiers. A lot of those issues have been resolved. So there were a lot of excess inventory in the system, right? So that towards say 2021 end reached 10-year low inventory. So that was sort of a turnaround point. Secondly, the absorption rate, meaning that the projects which are launched, again, how quickly do they get sold? Today, again, it's at the fastest rate in the last 10 years. Right? And thirdly, interest rates is one of the factors, right, which impact. But a lot of times, it's like stock market. When the prices go up, the buying actually goes up. Because the interest goes up. People who have bought real estate, say 2 years back, and if they see that they are making money, initial buyers are mostly the buyers who want to live in those the flats, but then they are followed by investors who are coming in for making profits. So I think investors have just started coming, and with rising prices, I think generally this cycle lasts for 4 to 5 years at least. So I think we are at the starting phase of that. Interest rates have gone up, but I mean nothing compared to what they have gone up in the US, right? Our interest rates anywhere were 5.5%, 6%. They have gone up to 7.5%. So 1.5% rise in interest rates, and that too it's a variable interest rate. It's not like US. See, in US, what has happened is that most 90% of the investors in the US or 90% of the home owners in the US have a fixed mortgage rate, right? So that fixed mortgage rate, everyone had refinanced, and it was at the lowest end. 2.65 is what they reached, at the lower end when the interest rates were low. Now the same interest rate has gone up to almost 7%, 6.5, 7%. So almost 2.5, 3 times is what it has gone up by. So of course it will have a huge impact on the real estate buying, because they want fixed. In India, it's a variable interest rate. Very few people have a fixed interest rate. So today, even if they get it at say 7.5%, 8%, even today, I mean the interest rates, you can get a mortgage at 8%, and which is not too much different than what say you got it at 6.5%. But then that 8.5% will go lower if you can always refinance and get it lower if the interest rate goes down in a year's time. And the expectation is that the inflation is going to go down going forward, right? So in a flexible rate, people don't worry too much about that. As if the interest rates go down, they will refinance that. They are not doing a fixed rate. So I don't think Indian real estate is that much sensitive to the interest rate as much as US market is, and hence I'm not too much worried about the interest rates going up by 1.5%, because I think now they have peaked. It will trend down, and as an investor, it's all about demand supply. Because of RERA, the number of builders have gone down, right? So you are betting on not just the overall real estate market, you are betting on companies. So the competition for the existing companies have gone down significantly, and that's what an investor, so what used to be 10 years back and today, there is a huge difference in the structural nature of the industry, which has improved a lot. From an investor perspective, it has become much more safer, right? So it's not like same thing as what was in 10 years back. So with that changed environment, I think it's probably not pricing in, because it still keeps on comparing real estate with the history. But things have changed a lot, and I think you will see that in terms of the cash flow that these companies will generate over the next 5 years, and slowly I think they will get re-rated. So there will be multi-baggers, in this space over the next 5-6 years.
Sure, Samit. So, while you did discuss about the specialty chemical sector, where you find that sector is now kind of going through struggling times in terms of reducing margins, and at the same time, we had been seeing China plus one as a positive impact, which was kind of impacting manufacturing and specialty chemicals as a subsector of that. So how is this particular element of China plus one as a advantage, or as a driving force behind many fund managers as well as investors bullish about India's growth story playing in the current context on ground with regards to various industries, especially manufacturing?
Right. I mean, see, China plus one is something that everyone started talking about. Every fund manager, talking about the same thing. And it's not that easy. I mean, you see how China has come back. They are dumping everything. In between during COVID times, there was no dumping of tiles in Indian markets. There was no dumping of MDF in the Indian market. There was no dumping of chemicals in the Indian markets. Right. So when you hear such stories of China plus one, you start believing in that. So much have stopped. There is no import, and now India, is ready for the. But now suddenly, if you look at last 6 months, 7 months, it's worse than even pre-COVID, right? So there is so much supply which is coming in from China. And after all, see, whoever is buying, the customer will always go to the lowest cost. It doesn't matter where it's in India or, a lot of things get bought at a spot level, right? So I don't think, it's prudent for investor to just believe in the China plus one story and blindly go behind sectors. It's, I think, all about very company specific. If that company has significant competitive advantages against even the Chinese companies, they will sustain any kind of competition or dumping from China, because the Chinese companies won't be able to dump at lower price than what this company is able to sell. So it's important that irrespective of what the rhetoric is or what the story is, sticking with bottoms up specific companies, and there are such companies available even in the chemical space. So I mean, we have seen how companies in the fluorine chemistry have done well, because there's not much competition from the Chinese players in that segment. I mean, all the chemical, fluorine chemistry players have done well. So it's better to bet on such companies because they are the lowest cost producer across the globe, and they will tend to do well because, there's no fear of dumping which is going to happen. So it's better to go, bottoms up and, bet on such stories.
Sure, Samit. So we come back to the foremost aspect that I had discussed, in the beginning, which is underperformance of SageOne, which has come of late over last 1 year, which you kind of attributed to it starting from May till December, and then after that it's kind of again started to come up with regard with in respective to the benchmark. However, now talking about the future, let's say next 3 years, if you were to give guidance on how is it that SageOne is striving to continue to keep generating alpha, because obviously your last 5 year returns have actually gone down because of last, I would say, 1 year's performance, right? Obviously on 10-year returns, SageOne still looks to be attractive, but obviously you need to do something which is way beyond everybody's expectations, which is, I'm not trying to put any pressure, and I know there are no guarantees. It is ultimately, I again say equity is non-linear as an asset class, but at the same time, we want to hear your confidence, we want to hear guidance from you for all the investors and clients who are invested in your products or who are wanting to see current underperformance probably as an opportunity for them to invest.
Right. No, I mean, see, again, point to point returns are very tricky. Sometimes, especially in the small cap space where it tends to be very volatile. Imagine that the small cap index in at the start of 2018 was at 9600. Today it's at 9800. It's almost zero returns in the last 5 years. Right. During the same time, I mean, if you look at our returns, of course, it's going to be, it's not as good as last 10 years, but still in that, 10-11% kind of a range. And that was much higher, say, if you looked at 1 year back. Right. So point to point returns are going to be driven by whether you enter at really peak of the market, because if you enter at the peak and if you look at the returns at the bottom of the next cycle, things are going to look, pretty bleak. And that's where I think it's important to look at the median of the rolling average sort of as a good guide for returns. Right. Today, we are not either at the peak or nor at the bottom. We are somewhere in between, but I would say we are closer to the bottom than closer to the peak. Right. So at least here on, we don't have that big baggage of high peak valuations, to start with. Now the drivers of growth or returns are going to be earnings growth. So for example, if the P multiple in say 2018 was at 30 times, by 2020 the P multiples had dropped to 15 times for the portfolio. So even if from 2018 to 2020, in the next 2.5 years, if the earnings had even doubled, my returns would have been zero. Right. So now question is what will happen going forward? So we have never had a 3 to 4 year period when the portfolio earnings haven't doubled, the valuations sometimes have halved, and because of which the earnings are much more predictable than the P multiple that the market ascribes to the portfolio. Right now, I am fairly confident that in the next 3 years we would be able to deliver earnings growth of the portfolio in that range, 18 to 25%. Right? I do not know 3 years down the line what will be the P multiple that the markets will ascribe. It will depend on sort of the sentiments in the market at that point in time. It can be bullish, it can be really pessimistic, right? But our goal will be at least to deliver the earnings growth and let market decide what the P multiple is. Generally, if we are okay, if we deliver the earnings growth, then P multiples at least will remain as much as what they are now. I mean, the P multiple today are not crazy. They are below average, I would say, what we have seen in the last 7-8 years. Right? So the starting point is not bad. Earnings growth visibility, I think, is pretty reasonably good. And hence, let's see how. I mean, it's very difficult to, understand what the market P multiples are going to be during that phase. But I would be pretty confident that in the next 3 years, there will be at least one peak. There will be one peak because the last peak was in 2021. And that will be the time to, probably close our AIF at that time, return the money back to the investors, during that time. Even last AIF when we had it, 2000 and we launched it in 2000 and towards 2019 sometime, right? So, and then COVID hit. So a lot of AIF investors, their portfolios were down by 30% during the first year itself, right? After that, within the next 1.5 years, we more than doubled the money for all the investors. So from the bottom, it actually went up 3x, right? So that's how concentrated the returns are. You don't know when it's going to happen. You'll get 1 12-month period when most of the returns will be made, and during the remainder of 2.5 years, they will probably remain flat, and either down or flat. That's the nature of the returns. So unfortunately, I do not know whether it will happen in the next 12 months or whether it will happen in the next 24 months. But I'm pretty certain that it will happen in the next 3 years.
Samit, so my good wishes to you, and absolutely we are all sailing the same boat, and we hope for the same. The issue is that investors actually have very high expectations, and all the more because kind of there is a pedigree to your performance, and investors kind of have that faith and belief that because you have seen many cycles, like you confidently say last peak was 21 and now next peak should happen in say next 2 to 3 years. So obviously you have that understanding of the cycles. So with such deep understanding of cycles, especially the mid and small cap space, and with such pedigree, obviously then if underperformance comes, and that too deep underperformance the way it has happened over last 1 year, it is something which disappoints investors. And that is where it will be interesting to know what are the learnings that have been there. Were there anything that actually went wrong, or you were expecting this because valuations were high, and this has happened in the past also. It is the investor who actually needs to learn and kind of evolve with this journey. You have already evolved. So what is the I would say answer to this underperformance? Is it to do with some mistakes that happened and you and your team have identified that and fixed that, or it is something which is usual? An investor should actually kind of understand this more holistically, in the overall long-term context.
Right. So, I mean, see, learning is a continuous process. It never stops, right? Each cycle you learn something new. And it's not the first time. I mean, in the last 11 years, we probably had 5 or 6 times when we underperformed. So it's nothing really new. Every 2 years, we'll have one underperformance of 6 months or 7 months, right? Question is, whether we outperform in that 3 to 4 year kind of a cycle. And that's never happened. That in a 4-year cycle, we have never underperformed. Now, you never know. I mean, that can be the first. I don't, we can still try our best. We can still learn. But just because maybe what we are looking for, our strategy may not be flavor of the market, and we may still underperform. If the PSUs and the commodity companies keep on going up, it is very difficult that our kind of companies will, or the Adani companies keep on going up. they will outperform what we look for. So I think learning is nothing specific. There are different learnings in each cycle, which we of course try to learn. Every time we have underperformed, it's been extremely painful for us, because I mean, looking at investors disappointed, it's one of the most painful things that you have, because investors do look upon you to deliver better returns. Sometimes the investors themselves make better returns than what we do, and then there is nothing that we can say. I mean, being in the market for so long and still underperforming, I don't really have an answer. I mean, what we can do is just believe in the process that we have followed, believe in something which has worked for us, and believing earnings growth will deliver the returns. And I think we are pretty reasonably good at finding companies which will deliver earnings growth, right? So I think we hopefully will not disappoint on that aspect, and we will have a average sort of a market cycle average valuations in the next 3 years. And if that happens, then I'm pretty confident that we will outperform, because it is going to be very difficult for the markets to grow at beyond the nominal GDP, which is in the 10 to 13% range. And if we deliver 18 to 26% range, I think there is no reason why we should not outperform the markets. But again, I can't promise anything, or I can't be confident that I will deliver this, because I thought the same thing 1 year back and see what happened, right? So hopefully I wouldn't get unlucky every year, and there is underperformance, there is sort of flavor, things which didn't work out the way markets worked out in the last 1 year. There were very different kinds of companies which worked out. But I think the next 1 year maybe, or next 2 years, there will be time period when our set of companies, which are high growth companies, which are niche companies, there is no finance company. Then last 1 year, finance companies have done extremely well. Banking sector has done extremely well. In the last 2 years, Adani companies have done extremely well. There are a lot of infra companies which have done so well. So those kind of companies will never find a space in our portfolio. But again, those like a defense companies, or those government kind of companies where government in themselves is a big owner or customer of that, will never find space in our portfolio, right? And sometimes those kind of companies do exceedingly well, and sometimes from the bottom, these companies can double in a matter of few months. And if you don't have any of those in your portfolio, you can sharply underperform, and it has happened multiple times in the past. And so hopefully in a cycle, a lot of those things average out, even out, and earning growth is what finally will deliver you and that is what I will completely bet on. Delivering, and valuations will keep on going up and down. They have gone down in the last 1 year for our portfolio, but in the next 3 years, I'm pretty sure they will go back to sort of the fair valuation that they should deserve.
Sure, Samit. I think you answered this to my satisfaction, and I leave it to clients who have kind of based their faith based on the pedigree of SageOne. And obviously, one needs to have a long-term horizon, and one needs to have that approach of withstanding patiently during such tough times. And there is definitely, I see a lot of work that is being done at your end in terms of trying to continue to keep generating alpha. So now we have last 6 minutes left. We have discussed your overall process, which I started by kind of saying the word excellence, and I still maintain that. I did say that there is kind of no point discussing about markets, and we have not discussed that throughout. However, fund manager like you is here, and we cannot kind of let you go without knowing your views, because even today, overall kind of markets are still in the constant state of uncertainty, which is the characteristic of equity markets. Interest rates are expected to kind of maybe making their peak and not maybe go up higher further. Recessionary fears are still there, right? And in Indian context, maybe after 1 year is an election year. So obviously all these fears, all these confusions are still prevailing. And at the same time, investors do feel why I'm saying all these things and in what context, I wanted to address this question is that investors at this juncture get confused. Should they invest more in large cap or more in mid and small cap? Though obviously they feel that large cap as a side of market is more stable, is more established, but at the same time could be more expensive. But mid and small cap is relatively attractive in terms of valuation, but is volatile. But if you were to give that holistic opinion to an investor with a horizon of say 3 to 5 years, because over the last 20 months everything has come down, right? So how would you kind of address this particular aspect in terms of allocating
Sure.
between large and mid versus small? You can address maybe all these three
Right.
separate sectors.
Right. Yeah. First, I'll talk about the overall market. Maybe, I mean, as you said, yeah, there are a lot of fears in the market. There is interest rate fears. There is slowdown fears. There's competition. There's margins. There are wars. Which are going on, and how all of this. Now there is debt ceiling issue. There is, the financial sector in US went through a trouble, especially the regional banks, right? So generally, whenever there are so many worries in the market, typically it's a reasonably good time. Because at least the sentiments are not too bullish, and the valuations are under control. So it's not a bad thing to have when you enter a market. The more the worries, the merrier it is. For your long-term returns, right? And there is fear of recession. But see, I mean, history. If you go by history, then most of the market correction happens before the recession starts. After the recession has started, the markets actually do pretty well. So that kind of fear was there in the markets last year. I mean, you saw Nasdaq, S&P, all of that, corrected from 20%, 30%. But now even probably things would get worse, and the markets may do well. Same thing happened in COVID, right? I mean, COVID, the markets corrected so sharply within a matter of 3 weeks. They went down by 35%, and small caps went down by 45%. Right? Post that, things actually got worse. In the rest of 2020 on ground. But then if you look at the markets, how they went. So markets actually fear a lot about, but then they price in. I think a lot of that pricing in happened over the last, year and a half. And hence, even if there is recession, even if the interest rates, now I think they have peaked, but even if they, they are in this range for a little longer, I think markets did correct in anticipation of that. And these days, anticipation and correction happens very quickly, smoothly. So it's always, good to enter in the market where such fears are very dominant and it's in the mind of the investors. In terms of small cap versus large cap, I feel that, small caps, and that's sort of what I have presented in the memo, is that it does go through the cycles, and it goes through cycles when the correction in small cap is much larger. Average correction in the small cap index in the last 5 cycles, which started say in 2006, 2005-6, has been 45%. So when they peak to when they bottom in a cycle, the average correction is 45%. And then the average jump from the bottom to the peak is 2.7x. So if you invest 100 and it goes down to 55, and from 55 multiplied by 2.7, it goes to 145 basically. So in that 3-year period, you will have losses, but if you hold on, you will still make that 12-13% kind of a CAGR returns, right? And if you are invested in companies which may not fall as much and which will probably go up more, then your returns are going to be higher. Now, question is, where are you today in that cycle of that small cap correction? I feel, the small cap corrected 33% from the peak in say 2021, and that happened towards October or December of this, last year. Right? From there, I'm pretty sure, since it didn't correct 45% from the peak, it corrected less. Maybe it will not bounce more, but instead of going say 2.7 times, it may go up 2x from here. So that is definitely possible. And during such bottoms, there's a big gap which gets created in terms of valuation between large caps and small caps. And during the peak, there is almost no difference in the valuations of small caps and mid caps, which probably happened in 2021. Of course, it in hindsight now, it wasn't. If I knew it, obviously I would, be sitting on cash during that time. So today I feel there is a pretty wide gap between the valuations of small cap and large cap. If you look at the median valuation of small caps today, it's around 19 times. The median valuation of the top 100 stocks, which are the large caps, it's around 26, 28 times, around that time. So there is a pretty wide gap, almost say 40% higher is the valuations of large caps. So I think it's a reasonably good time. What you need to do, based on my learning in this cycle, is that during such times it's better to have higher allocation to the small cap space. And when it peaks, when the gap in valuation between large cap and small cap narrows, at that time reduce your allocation to the small cap, and at that time maybe have a higher allocation to the large caps. So it's important to do that tactical adjustments, and to take advantage of the volatility in the small cap space. Because if it's going to be so volatile, going down by 33, 34, 45%, you need to, book some profit before it happens, and then allocate larger sum when it happens, so better to have that. So as I said, I expect the peak to happen probably towards end of 2024, 25, if history is to go by over the last 5 cycles. And during that time, you can reduce your weight to the small caps. But I think today is a time when it's probably going to be more rewarding to have higher allocation to the small caps, compared to what your target allocation is. It's everyone will have a different allocation, but compared to the average allocation that you intend to have for the small cap space, I think today it's better to have little higher allocation and then compared to that average allocation, reduce it below that average when it peaks and allocate that somewhere else.
I think it has been really insightful conversing with you as it was expected, and thank you everyone for logging in today. Thank you, Samit, for spending 1 hour.
Sure.
I think the kind of points that you discussed about specialty chemical sectors, real estate sector, your conviction with regards to valuations of small caps, and the process that we discussed for SageOne, it actually reinforces our confidence, and that's exactly what we do. This is what I'm going to tell to our audience, who have been supporting us throughout, that we at PMS AIF World actually kind of started our business on the belief that it is important to identify people behind the product. Mostly investors, over years have been kind of investing money in brands, investing money in large institutions, not realizing who are the people behind those products. And obviously people also do not remain same ever. One needs to find good people and at great time. And that's exactly what we keep doing. And we objectively evaluate, not just subjectively kind of, study that. And that is kind of, with God's grace, given us good identification at right times. And our clients are really happy, because of all that. And because, when tough time comes, if we are in right hands, the conviction continues. And that's the most important aspect when it comes to investing in equities. So thank you everyone for kind of joining us today. And we'll be again back soon on next Friday by with the continuing of this rhythm. Thank you, Samit, for your time. Thank you.
Absolutely, my pleasure. Thank you so much, and really appreciate the patience that investors have shown, and hopefully will not disappoint.
Thank you.